in Europe. Welcome to the Probus Pleion Quarterly Outlook. I am Staudenmann, partner at Probus Pleion, and it's a privilege to be your host today. Thank you, dear audience, for joining us. 3 months ago, I opened this session with the following questions. Will the US dollar melt further? Is there more upside to gold? Will equity markets go beyond the current all-time high? Where are interest rates heading to? Would you agree that the very same questions are still valid today? What else should we try and answer to you today? Please let me and the team know using the chat function in Zoom so that we can make sure you get your answers delivered. Thank you for your active participation. We're delighted to have 2 exceptional speakers for you today. It is a great pleasure that we present Birgitte Olsen. Birgitte Olsen has made a difference at the forefront of investing for several decades. She spent significant time successfully investing in European markets. She is the head entrepreneur investment at Bellevue Asset Management in Zurich. Initially, however, Adrian Kirigin, the chief investment officer of Probus Pleion Middle East, will take us on a journey around the globe. Before we start, I need to cover a few technical points. Please bear with me. As stated before, I'd like to encourage you to use the chat function for your own personal questions from the very start. This will help me and the team to organize and handle your questions. Thank you. We discuss the global economy as well as geopolitics in a broad way. We'll dig deep into Europe and learn about market segments worth considering. We'll cover macro topics in some detail and share our asset class preference. However, in order to remain compliant, we'll not be able to share securities advice during this call. Our content is not to be seen as investment advice to you. We do not give investment recommendations to a broad audience. Our presenters state their own views, opinions, and strategies. My colleagues and I will be happy to assist and answer your personal questions and recommend a strategy and investments that fit your personal situation during bilateral discussions. We want to make sure that our recommendations are meeting your expectations, are within your risk tolerance, and help to achieve your goals and ambitions. Besides this, we'll assure compliance with both our regulations as well as your local rules. With this, let me hand over to Adrian Kirigin, our Chief Investment Officer in Dubai. Adrian, the floor is yours.
Thank you, Mark, and thank you, ladies and gentlemen, for joining us today on this quarterly webinar. I will now share my screen. Mark, if you could just confirm once you see it.
Yep, it's starting. I'm sure we'll have it live shortly. Yes, we're there.
Great. All right. So let's begin. So the objective that we have during this quarterly webinar is to provide an accurate view, to the extent possible, of where we stand in the macroeconomic environment. More specifically, what is the likely direction of growth and inflation over the next quarter? Because the combination of the direction of growth and inflation has key implications for asset classes. So we'll start first with the US economy. And on this slide, what you can see is the evolution of the expectations for US growth in 2025. So as you may recall, at the beginning of the year, expectations were very elevated for growth in the US. And of course, with the sort of Liberation Day tantrum and the aggressivity of Trump policies, these expectations were significantly revised lower. from, as you can see, a peak of 2.3 to a trough around 1.3%. Since then, they have been creeping back up. Why is that important? Because the consensus tells us how investors are likely to be positioned, and we need to contrast that with the view that we're trying to form. So why has, specifically, why have expectations fallen so much? What you can see here is, of course, tariff collections on a monthly basis that have significantly been ramped up in 2025, right? Unsurprisingly so, given Trump's policies. You can see that they are currently around 30 billion per month, which obviously is around 360 billion annualized. And the expectations were that this should impact significantly consumption. There has been, of course, a lot of uncertainty seen in various surveys, such as consumer sentiment, business sentiment, etc. But the actual impact on growth was expected to occur in Q3, something that we also thought we would have some negative growth surprises in the US in Q3. But when we look at the details, typically, if we look at the various measures of consumer health, whether retail sales or personal income and personal spending, they have actually surprised significantly to the upside. And so we need to ask ourselves why. When you look at this chart, you can see an estimate of the impact of tariffs on the various income cohorts in the US. And that is the top part of this, the top chart. And you can see that the bottom decile of earners are the ones that are impacted the most. On the other hand, we also know that the bottom decile of quintile, the bottom 10, 20% of consumers contribute very little to overall consumption in the US economy. If you look at the bottom part of this graph, you can see that, and this was 2023, so the top 20% were contributing 40% of overall consumption. The latest estimates suggest that the top 10% of consumers contribute 50% of overall consumption. So we have what has increasingly been called a K-shaped economy, right? So you have the wealthier cohorts of the economy that are doing okay, and those that are at the bottom part of the income spectrum are indeed suffering from this, the current policies, which, of course, it is noteworthy, is completely opposite to what Trump had initially stated were his aims. Not surprisingly so, he has completely changed his stance through his policies. Now, what about the top income cohorts? You can see here at the bottom part of this graph the equity allocation of U.S. households. Obviously, the asset owners are the wealthier parts of the U.S. population, and you can see the equity allocation is at 45%, which is the highest it has been in this series, probably going back 100 years at least. And it tells us two things: that as long as equities continue to go up, there is a positive wealth effect that is quite significant. In the first 6 months of 2025, that positive wealth effect was $5.3 trillion. And obviously, since then, equities have continued to do well. So you have the wealthier cohorts of the US economy that continue to support consumption, whereas the bottom ones that don't have too much of an impact are actually badly affected. Now, we need to acknowledge that there were some negative growth surprises during Q3, and they were concentrated in the labor markets. What you see here is that payrolls, job creation measure, which is the top part of this graph, has indeed slowed down. Right? The latest readings, around 22,000 jobs created, are quite low, close to being, recessionary, or let's say leading to recessions. But the reality is that so far there is a possible explanation that has credibility, that the labor supply and demand dynamics have been shifted because of immigration policies by the Trump administration. So there are estimates pointing that net migration in the US is actually falling, is likely to be flat to negative. So that means that the labor supply is falling significantly, and therefore the labor demand, the equilibrium rate between these two, the demand and the supply, has shifted lower. That means that the unemployment rate could remain with very little upward pressure, despite the fact that payrolls are slower. So this is a possible explanation that has credibility, but nonetheless, this is an orange light, to say the least, that the labor market that has significantly slowed. If you look also at jobless claims, another reading of the number of people claiming unemployment benefits for the first time, it has been range bound. That's the bottom part of this chart. So we are in the situation where there's very little hiring, there's very little firing, but for the time being, the income of consumers remains supported. So this is probably the most important element to focus on or to follow in the next quarter. Now, if we look at other measures or indicators of growth, we already saw that retail sales have been resilient. If we look at small businesses, the survey of small businesses in the US, it has actually also been recovering in the last, this is the top part of this graph, in the last few months. We also see that actual earnings changes for these small businesses are also moderately improving. Also noteworthy at the bottom of this graph that hiring plans from these small businesses are also stabilizing to slightly improving. So this is something that challenges a bit the view that the labor market is on the verge of breaking down. Why? Because small businesses, private small businesses in the US account for over 50% of employment, non-governmental employment. So they have a significant impact on the labor market. So this is something that not only has been seen in surveys, but as we'll see later, was reflected in market action, which in the end is the final arbiter of truth, right, when it comes to economic theory. So the other element that needs to be considered, and what you're seeing here, is the deficit, the budget deficit as percent of GDP that was expected before the Trump administration planned or passed their recent spending bill. It was expected that the deficits, if you look at these blue bars, was going to shrink in the coming years. Because let's not forget, in 2025, in Q1, there was a lot of talk from the Trump administration that they needed to cut spending. Obviously, since then, it has gone out the window. And you can see that the revision following the passing of this bill for these deficits was significant. Right? We're talking about a budget deficit of 7% in 26, 7% in 27, 7.2 in 28. It is a very significant support for the US economy. However, it is noteworthy again that it is largely beneficiary to the higher income cohorts of US consumers through tax cuts. So this is also something that goes a bit against the idea that the US economy is likely to decelerate much further in the coming quarter. So if we go back to the expectations of growth that we saw at the beginning, around 1.8, it looks like the current GDP growth rate year over year is around 2%. And it's likely that growth going forward is likely to stabilize in the US and potentially moderately improve rather than decelerate. And that means that these expectations have potential to be revised even higher. We will make the connection with this once we get to the actual equity market and how investors are positioned. Now, moving to Europe, where there's been a lot of news recently. The main sort of tailwind or structural shift that we've been discussing for 3 quarters has been the abandonment of the debt brake in Germany, right? And the increase in fiscal spending. 500 billion of infrastructure spending with around 120 planned for 2025. A very significant tailwind, but more importantly, the historically conservative Germans are more tolerant towards fiscal spending, which obviously encourages other countries or let's say there's less pressure on them to reduce their deficits. So what you see at the bottom is that the actual spending from governments on infrastructure and investments in general are likely to pick up in a coordinated fashion, which is rare, which is a main reason for our constructive stance on Europe. Now, there's been a lot of talk recently with the debacle in France, with yesterday Le Cornu resigning after 3 weeks. And the impact that this has had on and this is obviously not only a story from yesterday. We had it a month ago. There's a lot of political tension going on, and we're seeing that, let's say, the bond market, especially if you look at the French 10-year yield that is currently at 3.6%, that is currently higher than Italy's 10-year yield, Greece's 10-year yield, Spain's 10-year yield. So the situation in France is clearly dire. Now, can this overwhelm the fiscal impulse that we're likely to see? Well, probably not. That we're seeing, rather, probably not, because they've tried to have a sort of centrist government initially with the idea with Bayrou to cut spending. It didn't work. And now it will be increasingly hard to even consider cutting spending at the government level. So that means that you still have the sort of fiscal impulse that's likely to drive. The only thing that you basically need, it could create some uncertainty in the short term, business sentiment could come down. And as we'll see when we look at European equities, can have a temporary impact. But the constructive stance remains. And that means for other reasons as well, that the European growth engine is likely to sort of continue to do okay. Leading indicators that we look at also point that there shouldn't be a major impact from this situation. One element that we continue to track that has been a big reason for our constructive stance on European financials, which is the best performing European sector this year, is that loan growth has continued to do well. Now, you can see at the top part of this graph, loans to households, loans to corporations, they have been on the way up. Now, if you look at surveys, it looks like there's potentially a rollover in the magnitude of demand for these loans. So it is important to keep an eye on that, as there's been already a significant rally, but this continues to underpin as well the growth in the EU economy, as long as credit continues to grow as well. Now, we looked at the growth situation in the US and Europe. So far, the conclusion is that on the growth sides, there's a higher chance that growth in the US will actually stabilize to improve rather than decelerate further. And in Europe, there could be a little bit of short-term, let's say, fears or concerns because of the political situation, but the growth impulse on the fiscal side should overwhelm it going forward. Now, on the inflation side, there's been a significant shift in Q3, right? As we had discussed, as quite likely during our latest quarterly, is that inflation has bottomed out in the US. It has also likely bottomed out in Europe. You can see at the top part of this graph that US inflation, whether you include or not food and energy, you can see that it has bottomed and it is on the way up, right? With headline CPI at 2.9%. On the European side, inflation has bottomed as well. Actually, the latest number points to 2.2% inflation in the euro area. Of course, the dynamics are slightly different. We're unlikely to see an acceleration such as the one we see in the US in European inflation, but it has indeed bottomed. Now, why has US inflation picked up so much? The big driver, as was quite likely, is the impact of tariffs, right? When you consider that goods are about 20% of US CPI and that 50% of these goods are imported. So when you have tariffs on these imports, it has an impact on goods inflation. And we can indeed see, if you look at the top part of this graph, that this blue line is actually the contribution of core goods to US CPI that has gone from negative 0.3 to positive 0.3 and is likely to continue to go up. So this is clearly something that points to inflation potentially continuing to move up. At the same time, if you look at services, which had contributed to disinflation, they are also stabilizing. So we continue to see upward pressure in US inflation. So how do we tie that to bond markets, right, and to Fed policy, central bank policies? Well, you can see here that bond yields in the US, which is the top part of the graph, the gray being the 2-year yield, the 10 being the blue line being the 10-year yield, and the same in the bottom for Germany. We can see that in Q3 we've had quite a shift lower in bond yields, right? The reason for that, and despite what we just observed, which was that inflation actually stabilized. So the question is, of course, why have we seen such a big shift lower? Well, a big development of this quarter that really is extremely important to underline is the increasing pressure that the fund administration, the Trump administration has placed on the Fed, threatening in the end its independence or its ability to conduct monetary policy without influence from the executive branch of government. And how has that translated? Basically, expectations of Fed cuts have been priced into the curve to an extent that is potentially not justified by the economic environment. So if we look at this, let's just look at the blue line here at the top part of this graph. You can see that the market, after the Fed's cut in last September, the market is still expecting 45 basis points of cuts this year. And next year, an extra around 0.65, right, which you can see at the bottom part of this graph. So we are talking about 1.1% of reduction in rates, which seems to contrast quite significantly with the potential for growth to stabilize or improve. So the Fed is trying to hide also behind the labor market weakness we've seen as a potential justification for cutting rates, but it is, in our view, there is too much priced into the curve or expected from the Fed in terms of rate cuts. But this has had a significant impact on bond yields. It has pressured these 2-year and 10-year bond yields lower, as we thought was quite likely for Q3 because of potential growth surprises that were underwhelming. But on top of that, this pressure from the Fed. The question is, going forward, what is likely going to happen? If our scenario, which we think is the most probable, is for growth to stabilize or improve and inflation to pick up, the 10-year yield has very little to do where it is in the US. On the short end, however, yes, there could be a potential short-term rebound as we are seeing now, but it's likely to be pinned by this increasing fear that the Fed will be potentially forced to cut, or there will be a chairman starting May 2026 that will cut rates irrespective of the economic environment. So conclusion on the bond side, the duration now is not attractive at all on the 10-year and beyond in our view, whereas in the short end, the bonds should do okay. You know, the 2-3 year is still safe to be positioned in. Germany, as we discussed earlier, the duration side in Europe continues to be very unattractive to us, and therefore no point getting exposure there. The ECB is likely done cutting rates. We can see that next year there's about a 20% chance of one cut that's priced in, which probably tells us that there's not going to be one. So again, there's upward pressure likely in European yields. Now, why is the Fed, or why is the US administration pressuring so much the Fed to potentially cut rates? We know that fiscal deficits are going up. Well, the problem is that interest payments are now above $1 trillion, right? From or below 600 billion 4 years ago. And so they have about 35%, 34% of their debts that they need to roll over between this year and next. So of course, having short-term yields that are lower would significantly help on the spending side. Right? But this is the type of policies or policy decisions that should not be taken because it has a significant impact on the currency, right? So if we look at the currency, the dollar that we still think is in a bear market, it has indeed fallen quite significantly this year, right? The problem is, of course, that even in bear markets, there can be significant snapback rallies. There can be, phases of consolidation, as we thought was likely for Q3. The question is now going forward whether another leg down is quite likely. So projecting ourselves just for the next 3 months in the short term, one of the big drivers of the dollar is the amount of cuts priced into the curve, right? If you look at the market pricing of the Fed funds rate in 18 months, which is this gray line, it shows you that the market thinks that the rate of the Fed will be at 3%. Right? But what you can see is that this blue line, the dollar index, is following that gray line very closely. So it's basically moving largely because of these expectations of aggressive cuts. So in our view, there is, if the scenario of reflation that we think is most probable materializes, a little bit of these excessive cuts could be priced out. And therefore, you could see this gray line continuing to move higher, potentially temporarily supporting the dollar. Again, should there be such a rebound, investors should fade it and at some point, sell the dollars against other currencies, whether the yen or the euro. Because we think that the dollar is in a structural bear market, because eventually the Trump administration will succeed in influencing at the margin that decision, which is obviously a negative situation. Another big element to consider is that there is an enormous imbalance in global capital markets. Capital has been accumulated in US markets, and for good reasons until now, for years and years, for over decades, with an accelerating pace. What you can see here is the imbalance of this capital between US markets and foreign markets, right? The net of the amount of capital the US has invested in foreign countries versus the amount of capital foreign countries have invested in the US. And that balance is negative $26 trillion. And, with the policies that Trump has put in place, the tariffs that are likely to stay, the aggressivity of the way he deals with international relations, and the amount of policies that each country, each region is putting in place to convince capital to potentially stay a bit more domestically, this imbalance over time is likely going to be reduced. And that means that flows, which to be fair this year have not been major, in our view, are likely to, at the margin, go towards these other markets. And what do we see this year in terms of equities? We see that US equities are underperforming international equities, right? The gray line is the MSCI US, and the dark line is the MSCI World without the US, right? And you can see that even though Q3 has seen the US market catch up a bit, international equities continue to outperform. And in our view, which is a bold call, let's say, we still think that international equities are likely to do better. That this is where most of the opportunities are, given these imbalances and given also the domestic tailwinds we see in Europe on the fiscal side, in China on the fiscal side, in Japan, and the valuation component, of course. Now let's look more specifically at the performance of these various indices. The gray bars are showing you the year-to-date performance of all these markets, and the blue bar is showing you the performance in Q3. So the first thing that we see is, of course, that Chinese, European, and Japanese equities have done quite well in year-to-date terms, but that the leadership of European equities in Q3 has sort of waned a bit. And this is consistent with the political tensions we've observed that has sort of put European equities into some sort of consolidation mode. But year to date, we see quite clearly here how even the Nasdaq has not sort of kept track with these other markets. It's interesting to make the connection between these performances and the expectations for earnings growth for all these markets, right? And these bars are basically showing you how these expectations have evolved over time in 2025. And you can see that, let's say, if you take this dark bar and you move to the right, this was expectations for earnings growth at the beginning of the year for your US equities for 2025. And it has, and then at the end of Q1, end of Q2, end of Q3, and you can see that it has sort of bottomed out at the end of Q2, and in Q3 has been revised up, which is quite consistent with what we're seeing in equity performance, right? With Q3 being quite solid for US equities. Now, if our scenario that growth in the US is likely not to decelerate further, stabilize and go up, profit growth is likely also to be sustained, right? On the other hand, European equity earnings expectations have been significantly revised down, and they have gone too far in our view you can see here that now these expectations are quite negative. In our view, this is likely to be sort of exceeded with actual earnings results, which should provide some upside to European equities. We can see something similar for Indian equities, big revisions to the downside. China has been fairly stable. Japan has seen an upward revision. So it's quite consistent what we're seeing in equities. Now, looking specifically at US equities. So equities have actually continued to rally and done quite well, particularly in Q3. The question now is, so why have they moved up so much? It's likely to be because equities are anticipating that the economy is not going to go in a recession. It is also likely that part of this fear or concern that I've expressed earlier, that the Fed is likely to, the Fed's independence is likely to be eroded, is pushing investors to potentially, be into real assets, such as equities, such as gold, as we saw, as we will see, is the best performing asset this year. But interestingly, when we look at positioning, if you look at the institutional players, it doesn't look like equity allocations are really at the highs. And why? Because there were legitimate concerns to fear a growth slowdown. It has not materialized yet. It may end up, but for the time being, it hasn't. And as equities continue to grind higher, it forces allocations to be adjusted, right? And you can see here, this graph is a bit messy, but you can see that this yellow line or green line, whatever, is the allocation of discretionary investors. And this allocation is fairly neutral. The dark line is showing systematic strategies that basically just buy when volatility falls, but discretionary investors have been a bit cautious. And so this is probably what's driving this equity market on any deep dip higher. So another important observation is that in Q3, the segment of the market that has done quite well is US small caps. Right? You can see that small caps are up 12% in Q3, outpacing the NASDAQ, outpacing the S&P. And that is also potentially an indication, as we saw with business surveys improving, et cetera, that the market is not expecting growth to really decelerate from here, rather potentially supporting our thesis. Now, on the sectorial side, you can see here again similar chart as earlier: year-to-date performance in gray, quarter-to-date or Q3 performance in blue, and we see that on the technology side, the AI boom continues. It's been simply astounding, although the recent signs that customers and suppliers are investing into each other or stimulating demand in this way is quite concerning, but this is a topic for another day. You can see that industrials year to date continue to do quite well. You can see financials as well in the US, and these are sectors that we continue to like. They've been a bit on the back foot in Q3. There were growth concerns, etc. But going forward, we'd be inclined to buy dips in these industrials and financial sectors or companies rather than chasing technology here. In Europe, you can see here the Euro Stoxx 600 that has actually, after a long phase of consolidation, broken out. Again, the market's potentially telling us that the concerns over growth are not too significant. There's obviously a bit of a retracement now. Sentiment has been on the weak side, so you could see a retest of this level. But again, being long European equities continues to be attractive to us. I'm sure Birgitte will develop on this later on. Sectorially, as discussed earlier, financials are the best performing European sectors, 34% year to date. In Q3, they have maintained their leadership with 8.6%, which is quite remarkable. We would be inclined to, place some stops here and protect these gains because they've been quite exceptional, especially if they were to be a little bit of a volatility event on the bond market in France or something like this could easily lead to short-term weakness there. And the other sector that we really continue to like are industrials in Europe, right? We think not between the fiscal spending boom, but also what's happening in Asia with increasing integration of China, India, Russia, Southeast Asia also having a better dynamic on the investment side. CapEx expenditure are really going up. We think that the industrial side is very attractive because a lot of these European companies have exposure in Asia, and we think this is still where you want to be. Just a couple of words on China. First, it's important to note that Chinese growth has been below expectations in this last quarter. There's been a number of disappointing data points on the real estate market, also on the retail sale side, industrial side. But if we look at a number of indicators such as money supply growth continues to improve, suggesting that there is continues to be the impact of previous cuts and stimulative policies continues to feed through to the economy. But more importantly, the latest development, you may have heard of it, is called the anti-involution policy that the Chinese government has put in place. There's been a saying, I think, from Louis Gave that, when China enters a room, profits walk out because they compete so fiercely and they are willing to produce below cost that margins in that industry completely collapse. You can just look at the solar sector to have a good visual explanation for this. Well, now they've actually decided to put in place policies that are designed to curb excessive capacity and to stabilize margins for businesses. You can see here that Chinese producer prices being in contraction territory has been a big concern. And this is the latest way to stimulate potentially corporate profits as well in China. And we think that this is, again, continuing to go in the direction that China is explicitly committed to supporting their market, supporting their economy. Chinese equities, as we saw, doing quite well. This is a China A50. It's a bit stretched currently, but pullbacks should be bought, continue to be constructive on this market. In Japan, you may recall that we were kind of in a neutral zone for Japan until this sort of consolidation that had lasted for 2 years would be taken out, which we thought was likely to the upside. As you can see, Japanese market has run quite nicely in Q3. We have the news, of course, over the weekend that the PM now, first female PM in Japanese history, is likely to be quite tolerant towards fiscal spending. That means, of course, that it's going to be supportive for growth. But one of the big stories in Japan remains, in our view, that there is increasing inflows from domestic buyers, households. Japanese households have $15 trillion in financial assets and only 20% in equities. So we continue to like the Japanese market, and it needs to be bought on pullbacks. Then a brief comment on commodities. So if we think about asset class allocation, if the view is that growth is going to hold up and inflation is likely to accelerate, well, commodities should be doing okay, right? It's an asset class that should protect against this sort of inflationary backdrop. The commodity complex has been segregated in a way. It's been a bit big dichotomy between energy markets. As you can see, the top part of this graph, WTI, continues to be under pressure because OPEC Plus is curbing their production cuts, so increasing production. And this has clearly weighed on energy prices. On the other hand, you look at some other commodities, industrial metals, notably, they've done extremely well. And commodities as an asset class have clearly, they're forming a base. They need to be monitored, and there are quite interesting opportunities in that front. We've had, typically positions and continue to have positions in certain industrial metals and in nuclear energy or this type of interesting opportunities. Quick comment on gold. So gold has been, of course, one of the key elements of our portfolio. We thought that this consolidation that you can see here would be resolved to the upside, and basically what we need to be on the lookout for is how much exuberance is there, how is the positioning of investors on gold? And so one of the things we keep tracking and we've been following for a while and underlining it during these calls is the amount of inflows into gold ETFs, right? And this is the bottom part of this graph. And you can see that it has indeed started to accelerate quite significantly. You know, gold is up north of 40% year to date. Cuts are priced into the curve. So Western investors are now sort of chasing it finally. There's still no clear sign of exuberance when you look at these flows, and you have a lot of fund managers that don't have a lot of gold still. But again, now it's quite stretched. It's just a matter of, you know, buying pullbacks for those that are under allocated. You know, a 5 to 8% pullback should be bought. Gold miners, which we were quite constructive on, I think it's time to take some profits. It's been quite a great trade. They remain reasonably priced relative to gold, but it's just, you know, things are, when they go parabolic at some point, people need to trim a bit. So that is it. To conclude, for the time being, the most likely outcome is that growth will, at the margin, improve and inflation will accelerate, which is an environment where, you know, equities should be favored over bonds, particularly after the fall in yields we've seen in the previous 3 months, and that investors need to be on the lookout for continued signs of, you know, eroding Fed independence. That is really a key thematic, and so favor potentially cyclical sectors in the US and Europe. Asian exposure should be maintained, and finally, of course, this is the most likely scenario, but if we were to see some significant contraction in labor market data, that would warrant shifting our stance. So if the market corrects because yields are rising and the dollar bounces, it would be a buy. But if the labor market cracks, investors should probably take a more conservative stance, which again is not our base case. Thank you very much for your attention. And if you have any questions, there are many more topics we can delve into in a one-to-one basis. Don't hesitate. Thank you very much.
Thank you, Adrian. That was, as ever, very insightful. Birgitte, welcome to Probus Pleion Quarterly Outlook. It's a pleasure having you here. Before we look deeper into Europe, let me share a few points of your career with the audience. Birgitte Olsen is the head of entrepreneur investments at Bellevue Asset Management in Zurich. She joined the specialist asset manager in 2008 and assumes responsibility for European equities and institutional mandates. She previously spent almost a decade at Generali Investments in Germany as the deputy head of equities, managing European portfolios and thematic funds. Prior to this, she held key positions with Vontobel Asset Management in Zurich, and she started her career in the financial industry in 1994 as a sell-side analyst at Bank am Bellevue, focusing on insurance and pharmaceutical sector. She holds a CFA and is a graduate of the University of St. Gallen in 1992, with a degree in finance and accounting. Birgitte, it's an utmost pleasure to welcome you here. Tell us how you see European markets and how we should look at them.
Okay, can you hear me now?
We can hear you loud and clear.
Lovely, and you can see my screen as well, I believe.
Absolutely. Thanks a lot, Birgitte.
Thank you, Mark, for this very nice introduction. Yes, I would like to share with you the view from Europe and the view from within Europe, because this is what I concentrate on with my team, and a few interesting opportunities in terms of investment. So I will start by displaying the environment and where are we in terms of European equities, what we think in the second chapter would be the most attractive market segment of European equities, and how we do that in terms of investment philosophy here at Bellevue. So if you look at the total returns over the last 5 years, it's been a fantastic time for the S&P 500, and you see it here, the returns both in US dollars, which is the light blue, and the dark blue, which are very similar over the last 5 years. So the S&P 500 returned more or less 16% PA, a bit more. The MSCI World, which is now 75% of US, also returned 12%. And you see the Stock 600 in Europe returned more or less, 12, and small caps a bit less than 9. What we've seen now in 2025, which is a bit of a shock, is that the best category year to date is European small and mid caps. And you see that the returns in US dollars are more or less 30%, beating the broader indices in Europe, beating the MSCI World, and beating the S&P 500, both in dollars and in euros. So what has changed for European equities after this losing streak of 2021 till 2024? So this period of time was a very difficult time for European equities. We had, first of all, to cope with the post-COVID collapse of supply chains. We don't remember, but that really led to huge inefficiencies in production chains. We had 2022, the outbreak of the war in Ukraine, raising energy prices, the fear of a catastrophe actually for Europe, depending so much on Russian gas. And this witnessed record inflation and also an industrial recession. The industrial PMIs in Europe have been in recession territory since late second half of 22. Only emerging above 50 in the latest readings. ECB monetary policy was tightening, and we witnessed earnings per share decline, and also a massive capital outflow out of the region, out of Europe, into the US, with the emergency of AI, and also within Europe, out of small and mid caps into large caps and passive investing. With all of this, we had a massive derating of European equities, and the gap in terms of valuation to the US market increased ever much, so that more or less 30–40% discount to the US market was built up. Now, what has changed in 2025? Well, actually quite a lot. Supply chains have normalized across all sectors. I think aerospace is the last sector that still has to deal with some inefficiencies. The inflation has bottomed out, and we heard this from Adrian. Also, we have seen monetary easing from the ECB, and from a peak rate of 4%, we're now down at a deposit rate of 2%. We see good chances of the PMIs in the industrial space bottoming out, and a huge paradigm shift in the German fiscal stance. So under Merkel, we say in German, Germans were holding their portemonnaie very close to their chest, meaning there was very little spend, and austerity was the name of the game. And this, Europe was more and more isolated, as both the US and China are great fans of fiscal activism over the last years. And it took the change of the big coalition, the election of Merz, for this to be changed in Germany. But it actually, the trigger was probably the speech of J.D. Vance in Munich in February, where it was plain and open that Europeans had to start taking care of themselves. So we now have a big fiscal policy plan for infrastructure in Germany. We also see massive defense spending and several different plans from the European Union. And on the negative side, the new thing is that Europe has to face a situation where US tariffs have emerged, and the dollar is weakening. From a flow perspective and a corporate finance activity, we see a revival of M&A activity. We also see a revival of IPOs actually recently, and a stabilization and reversal of capital flows. Meaning that if I look at European flows for the large caps in Europe, they're more or less back at the levels or above the levels of 2021, Those flows are 50-50, more or less, active and passive. And for the small and mid caps in Europe, flows are back, but more hesitant, and we're still 20-30% below the levels of 2021, and even slightly below the levels of 2018. With this followed also a certain re-rating of European equities, but from very low levels. So for those less familiar with European equities, I want us to stress my first point is nothing is kaput in Europe. European equities are in good financial health. And to showcase this, I chose both net debt to EBITDA and also the EBIT margins. And you can see that there's no excessive debt in the European corporate world, be it large caps or small and mid caps. And actually profitability has been increasing as of late. It's important also to stress that small and mid caps in Europe have a very high quality, meaning that only 13% of European small and mid caps are actually in negative earnings territory. And this is different than the Russell 2000, where more or less a third of that index has companies that have not been able to produce positive earnings in the last 2 years. My second point is valuation. And you see here on the left side, the valuation, these are the PE 12 months forward. And we compare here Europe small versus Europe large. We see that actually after the exuberance of 2021, where small caps catched a very large premium to the large, small caps catch a big premium to the large caps, due to also negative interest rates. We are now at a discount to large caps, which is 9%. It's less bad than it was 12 months ago, but it's still below the long-term average, both in terms of absolute valuation and in terms of relative valuation to the European large caps. And you see this in terms on the lower left graph, in terms of standard deviation, it is quite remarkable. Now, equities are cheap in Europe, but what about growth? And what would be the drivers of that growth? Well, actually, the structural thematic growth drivers are the same. They have been for many years now. Some have gained importance, like AI, and new themes have risen, which is the event of Trump 2.0, but also the situation of Europe, and I would qualify that as a Europe 2.0. Automation, for instance, is a huge theme for European equities as well, and 50%, I mean, European companies command more or less 50% market share globally in the world of automation, and there's a lot of things to be done there, especially also with the turbo of AI behind it. So these are themes which are globally relevant, but also very relevant to European equities. And there is what we've seen, a global infrastructure capex cycle, and there's a lot of investments both in automation, in digitization, but also in resource efficiencies, in the energy transition and electrification. And the theme of deglobalization and the remodeling of supply chains has become super important and has accelerated now with Trump, with the second term of Trump. There's an interesting video you can watch on YouTube, which is Draghi was invited to speak with Citadel very recently. He talked about Europe, and you know that Draghi plays a very big role because he wrote an important paper that was published in September 2024 about the future and the opportunities for Europe. At that time, it wasn't embraced really, but we see now that with the new situation in terms of the transatlantic situation, Europe is really looking at themselves, caring for themselves, it's a clear a situation that Europe needs to be more competitive, more united, and find solutions for its problems. Draghi said the train has left the station, and for the train to accelerate, we might need something like a joint debt issuance for a common European project. And there are quite a few interesting aspects in that, both in terms of defense and infrastructure. For instance, there are 25,000 kilometers of grid waiting for permits in Europe. So there's a lot of potential for acceleration of investment plan at a governmental level and also at corporate level. There's also cyclical themes within Europe, because growth in Europe is not homogeneous. And we've had 3 years of zero growth in Germany, but we've had excellent growth in the south. We've had above 3% growth in Spain. This year's GDP in Spain is expected around 2.5 to 2.6. Adrian mentioned banks. We have there's a lot of very interesting and very national oriented Spanish banks, which have done really well. So if you look at Europe, you can pick and choose also and look at geographies and economies where growth is a bit more dynamic. Also, as we know in investments, it's not the position, but it's the direction that counts. Meaning that if Germany can improve from 0% GDP growth to anything above 0, it's going to be hugely beneficiary. And the same holds for the European Union. Now, if you ask me what are the most interesting spaces to invest in European equities, one thing I would like to stress here is that we've had a very long desertic underperformance of European small and mid caps, and you see it on this chart here. The MSCI Europe Small versus the Europe Large, and the columns is rolling 1 year, the overall underperformance of European small and mid caps. So from 2021, late 2021 until this year, we've had a very long streak of underperformance as capital was leaving Europe and mostly leaving European small and mid caps. And the derating, the subsequent derating. Now you see that this relationship is stabilizing, and we've seen now periods of outperformance of small and mid caps from a very low level. Why is this category interesting? It's interesting because it's less exposed to international trade, and actually the Trump event in the Rosengarten in April was actually the kickoff for the outperformance of European small and mid caps, as these are more or less 2/3 exposed to European business and only 1/3 exposed to international business, be it in the US or elsewhere in the world. And this holds true for most of the all regions in Europe, that the small and mid cap category is more looks more toward Europe and is less confronted with tariffs and a weakening of the dollar. Another interesting thing is that in terms of the sector constitution, the sector underlying the indices, if you look here, you see different European sectors. You'll find the Euro Stoxx 50, the Stoxx 600 in the middle, and also the Euro Stoxx Small. These are more cyclical indices, meaning that their weight in industrial is much higher. On average, you'll find 30% of the index is weighted towards industrials. There's less healthcare, especially big pharma. Interestingly enough, there's as much tech in the Stoxx 600 as in the Euro Stoxx Small, so you can benefit a lot as well in terms of those trends. And one has to I find it when one said 30% industrials, and they're called cyclical, so it's a very it's a bit scary because you think these companies would be very correlated to GDP growth, and we had none in the past 3 years. Now, a modern industrial company today worries much more about software than about screws and about hardware. And it's about becoming more digital, becoming more automated, and bringing solutions to the world which are related to data reading, and leveraging actually the digital aspect. And so if I look at our strategies, and I'm very, actually, I'm telling you the same thing Adrian is telling you. In the past 3 years, our outperformance was generated through industrials and financials. And it's quite remarkable to see this outperformance of the industrial segment of European equities in an environment where they're very export-oriented, and the local, national, European GDP growth was not very inspiring. Also, what you have to like as a stock picker is that you have a very broad universe of companies. And you see here the number of stocks below 10 billion in Europe, nearly 2,500. That compares to a bit more than 300 companies with market caps above 10 billion euros. You see also these are less covered by analysts. And when I see 7, I'm always a bit surprised, because if you look into Bloomberg, half of these people are not really, they don't really have warm blood, or they are sleeping at the wheel. So the coverage of small caps is a lot less good and more patchy. And you can find companies with actually no coverage from a sell side point of view. Also, the penetration of passive investment is much less, on average 16%. So this is a differentiator to the US, where more or less half, also the small and mid caps, are covered by passive flows. I'd like to tell you a little bit about how we look at European small and mid caps at Bellevue. And first, I'll start with the performance of this strategy, both midterm over 3 years. You see here the underperformance of the MSCI Europe Small ex-UK, which is up 50% more or less, versus 56% for the Stoxx 600, which is a broader benchmark in Europe. And you see that the Bellevue Europe Small strategy has been up 65% in that time. Also, year to date, the strategy has shown a good performance of more than 22%. That's at the end of September, handsomely beating both the benchmark and the broader European market. This is something we've been working on since many, many years, and the strategy was launched in 2011, and we've been covering small and mid caps. Myself, I've been covering small and mid caps for more than 30 years. But you see that in terms of performance, the strategy has been doing well compared to peers and competitors in the European space, both in terms of the Lipper classification in top quartile or even in top deciles for some periods, and also according to Citywire. It's very much a fundamental bottom-up strategy, and it lives by the quality of our stock picking. What is quite, I think, 2 things that differentiates us from other strategies out there is that we like to concentrate on companies where the shareholder base has skin in the game. And this is also a very European specialty, meaning that you'll find small and mid companies out there with families in the shareholding, families that have 60–70% of their wealth located in one company, not diversified, so they have to care. This very stable shareholder base brings a lot of qualities, which I might allude to a bit later. The other differentiation of that strategy is that it's very style agnostic. Typically, small and mid-cap investors would be focused on growth, and the best year they ever had was 2021, when interest rates were below zero and PEs were ever rising. We are very sensitive to valuation, we are very sensitive to cash flows, and we pick stocks in all different type of styles, both value, GARP, and growth. And this is a strategy that's been developed, validated, and optimized over the last 17 years. In terms of companies with a strong anchor as shareholder, what we like with them is that they have very strong balance sheets. So typically they have 60–70% equity ratio and still have a return on equity above average, which means that they have they're very well positioned in terms of, their access to credit is never a bottleneck. It was not a bottleneck in 2008. They grow by reinvesting their own cash flows, meaning they have to be competitive at what they do. They have to have good pricing power, good market shares, and generate sufficient cash flow to finance the growth of tomorrow. We also like the fact that CEOs tend to stay longer, 8 to 9 years, and not 3.7 years, which is the average in non-family owned type of businesses in Europe. So this makes for a very small and mid caps in a very high quality type of environment. And if you look at the strategy, you'll see that KPIs like net debt to EBITDA is 0.5. So we run a strategy with a very low level of debt, which is actually commanded by the companies. And this compares to, remember, I told you that net debt to EBITDA for small caps on average in Europe is now 1.2, 1.3 times. Also high EBITDA margins, so very competitive type of companies that are, for those who are international, have a strong foothold and are very competitive also in places like the US. And also a significant return on equity, although the average equity is by 60%. A lot of these companies are net cash, meaning that they have freedom to deploy both their organic and also their inorganic M&A strategy, which we think is very important in these actual times of low valuation for European equities. Now, what's the benefit of being style agnostic? On this chart, you'll see on the left is the average PE of all the positions in the strategy. And you'll see that the PEs are very diverse. We have PEs of 5 and we have PEs above 50. The core of the strategy is growth at a reasonable price. And you see that in terms of year-to-date performance, we've had successes in all these different categories. And actually, you find companies with PEs of 5 that have where their dividend yield is higher than the PE, which have benefited, which have brought positive performance to the fund year to date. These are not business models which are in restructuring or distressed. These are just companies that might sometimes have, are out of fashion. And value is a very big driver of outperformance, especially when you have a rebound of the market. And for instance, we have had 2 positions that have been taken out. One taken out by an American private equity fund, and another one taken out by the family themselves, who decided not to be listed anymore as their share was not catching the full potential their valuation. So my message is, if you look at small and mid caps investment, be wary of valuation. We have real interest rates nowadays, and it's important not to be too complacent when it comes down to valuation. I brought you a few anonymous case studies, but there's a lot of interesting companies in Europe, and maybe for the benefit of time, I'll shorten that a little bit. But you see companies which are very successful on an international basis in terms of mining. We heard about gold, copper, both very interesting places, and we see a rebound of the capex cycle in that category. I'll skip a little bit and I'll come to my conclusion, so we have more time for questions. But as a summary, I would say we have very attractive valuations, especially for European small and mid caps, both absolute and relative to the larger caps. We are in a situation of a fiscal upswing that has not yet materialized, but will materialize more in the course of Q4, especially in 26 and in 27. And we also have a potential for a cyclical upswing because of this as well, with the PMIs in the industrial parts bottoming up slowly. So we see attractive fundamentals. We think that small and mid caps as an interesting add-on to your strategies. It diversifies your position, as European small and mid caps are very idiosyncratic and are a heterogeneous source of alpha. Always a difficult word to say, also with a cold. And we think our strategies both display strength in terms of balance sheets and quality and agility. So with this, I'll turn to Mark and be happy to answer questions if there are any.
Fantastic, Birgitte. Thank you so much. It's extremely appreciated. I have, from the audience already one or the other question, and I see time is really running. So let me come straight to the points. In your strategy, Birgitte, how many companies, how many investments do you currently hold, and what's your average holding period?
We hold between 35 and 45 positions. Actually, today we have more or less 42 positions. And we think in terms of price targets. So we have all been analysts in our lives. So we model these companies and we have an upside and a downside. We like situations where there's much more upside than downside. And the average holding period can be anything from 6 months. I think the longest we've had is actually a company that caters to defense, but we've had it for 5 or 6 years in the portfolio.
Fantastic, thank you. Talking about defense, Adrian was saying that on pullbacks, defense stocks could still be worth a consideration. How do you see the topic?
I do think that we're becoming a little bit, we are now in a bit of an impatient phase for defense because Q3 might not give the evidence we're looking for, but it will improve a lot in 26 and 27. But it's true that when I hear my mom's hairdresser talking about defense ETFs, I also wonder about how much money has entered the space. So I think maybe now it's more a time for stock picking. And I still do believe that we'll see a lot of activity, but it's also going to be challenging for some of those companies who's been more or less close to the state and not used to maximize output and maximize margins. So the proof will be in the pudding, but it's a theme that is gonna stay with us for the next decade or two.
Thank you. And do you see, are there smaller caps as well in the defense sector?
Yes, they are. We do have 3 in our portfolio. 2 around 2 billion market cap, and And one I mentioned has been around for, I mean, we have had it in the portfolio for 6 or 7 years, and it's been returning top line 20% PA, even before we had the Ukraine war starting. So there are also second liners, which are less known than big guys like Rheinmetall, but they are very necessary. And you see also that the theme of defense is very broad, and soldiers cannot be forgotten. Even if we think a lot about drones and about heavy stuff material, we need modern soldiers with modern communication, and there's a lot to be done there too.
Fantastic, thank you, Birgitte. Then something for Adrian, more on the emerging market side. You were, discussing how markets outside of the US are doing. Of course, we looked at Europe now. Emerging markets, Adrian, in general, what is your view there? And in particular, how do you see Vietnam doing? I'm not sure, Adrian. Maybe your microphone is still off. I was hoping you're still there. Okay, it looks like Adrian has just dropped out. He was very busy answering some of the questions online. So we'll revert on that question. And let me take the opportunity to ask you for one or the other last question. But at the same time, really also say thank you to Birgitte, thank you to Adrian. It was extremely valuable to hear your insights. Dear audience, from me and my colleagues at Probus Pleion, thank you so much for joining us. We appreciate your presence. We're looking forward to add more value to you and answer more questions to you personally. We always say Probus Pleion Group is large enough to matter and small enough to care. So please do approach us with individual questions, and we'll make sure we answer them in a very succinct fashion and revert to you. I would like to take the opportunity to thank all my colleagues in the background who work hard to make these webinars both smooth and successful. Dear guests, on behalf of Probus Pleion Group, I'd like to sincerely thank you for dialing in. We're deeply grateful for those of you who are already our partners, and we thank you for your business and your trust. And for those of you who are contemplating joining us, we appreciate your consideration, your time you give us, so that you can discover the advantages of our offering and services. Thank you all for being with us today. We're looking forward to the next opportunity to see you in person. Goodbye and thank you.